US yields enter the magic resistance range. Everyone is watching the US-Iran war, oil prices, the Strait of Hormuz. We think the more important signal is somewhere else entirely. Welcome to Daksham's Deconstruct. I am Karuna from the research team where every week we pick up one big idea and follow the money behind it. Markets are fixated on the headlines, but the real signal right now is coming from the US bond market. The 10-year yield is at 4.6% and the 30-year yield is at 5.1%. These levels have repeatedly acted as a ceiling, a zone where the bond market tells the policymakers that the cost of keeping this unresolved is rising. And our view is simple. We may be entering the final leg of elevated oil prices, not because the geopolitical risk has gone away, but because the economic and the political cost of sustaining it is becoming too large to ignore. Three pressure points are now active simultaneously. Number one, retail gasoline prices in US have risen nearly 50% in 2 months. With midterm elections approaching, high fuel prices are politically toxic. Number two, with $39 trillion in national debt, every uptick in yields costs the US government more to refinance its own borrowing. The fiscal pressure compounds. Number three, higher yields put pressure on equity markets. When the bond yield rises, the valuation of equity generally comes under pressure. This particularly affects the long duration growth stocks. A falling stock market becomes a political problem fast. This is why the current range matters. A 10-year yield at 4.6 to 4.8% and a 30-year yield at 5.1 to 5.2% is not merely a technical level. It is the zone where the bond market sends a clear message. But here is the irony. The US is fighting a war in the region while simultaneously doing everything it can to keep the oil flowing. The Strategic Petroleum Reserve saw a record weekly draw of 9.9 million barrels. The US has extended a 30-day waiver allowing the purchase of Russian seaborne oil to help energy vulnerable countries facing supply stress from the conflict. One hand, the war is escalating, but on the other, they are releasing the supply. The US wants pressure without an oil shock, escalation without an inflation, geopolitical dominance without domestic economic pain. That is an extremely difficult balance to hold, and the bond market is reflecting the cost of trying. But Trump's incentive is shifting from escalation to claimable victory. The language still stays aggressive, but look at the actions. Releasing strategic reserves, allowing flexibility on Russian oil, pausing certain military moves, hence leaving room for negotiation. That combination usually signals one thing. The leadership is looking for a way to claim strength while preparing for de-escalation. For Trump, the ideal outcome is not a prolonged war. It is a settlement that can be projected domestically as a win. Iran brought to the table, US strength demonstrated, and energy markets stabilized. Whether that fully reflects the reality matters less politically than whether it can be sold as victory. This is what we mean when we say Trump's incentive is shifting from pure escalation to claimable victory. And when that shift happens, the oil price dynamic changes with it. So what's our view? Oil may be entering the last leg of elevated prices. Our base case is that the crude oil may still remain volatile in the very near term, but we are likely closer to the last leg of elevated oil prices. This does not mean oil prices will fall immediately. Geopolitical markets can overshoot. However, the risk-reward is beginning to change. The war is the story everyone is watching. The bond market is the story that tells you how it ends.